very much. Let's welcome in Harish Krishnan now. He's Executive Vice President and Senior Equities Fund Manager at Kotak Asset Management Company, who's going to answer some questions now. Harish, good to have you with us here. Thank you very much for your time. I was looking at, you on Twitter, and you're prolific. Lots of interesting stuff, apart from, of course, the here and now. But starting with the here and now, since we're talking about markets as they stand, what's your view? I mean, you put out a table in terms of the current drawdown in dollar terms and where India stands amidst sort of global peers. What's your view, though, from here? At 17,000 levels, have markets become attractive, or there is still some way to go?
Right, Prashant. So clearly from a drawdown perspective, I think the limited point that I was trying to make is that India in dollar terms is no different from most of the world, except, of course, China, which has seen a 50% plus drawdown over the course of the last 2-3 years. So we're down close to about 20% in dollar terms. Of course, sitting in India, as domestics, we see a far more shallower drawdown with the currency giving up a lot for the foreigners. Having said that, I think 17,000 levels of Nifty or above does present us with an opportunity to increase our allocation to equities. A lot of froth. We've seen a reasonably large time correction, close to about 18 months of time correction. A lot of froth, especially in the mid, small and micro caps, have kind of gone off. Large cap earnings have continued to be reasonably okay. Of course, the last 2 quarters, there was a spot of bother from a margin point of view. But we do think that margins can potentially surprise on the upside now going forward. So in totality, when we look at it, I think it still is going to be a range-bound market, but the current levels does provide a slightly more attractive zone to increase our allocation to equities, which is what we've done, for example, in our asset allocation products, where in, say, June, July of 2021, when markets were closer to their highs, we were at about 30% in equities, and today we are close to about 52% in equities.
Okay. So in the last 1 month, Harish, where exactly did you allocate your money? Which were the themes, the sectors?
So I think we continue to have a positive theme on manufacturing. That continues to be a theme where we see a slightly longer term promise and a potential to perform. The other sectors that we've kind of increased our exposures are to the auto and auto anchs. That's a space that has seen a reasonable amount of time correction, if not price correction, over the last 3-4 months, and we've increased our exposure there. Healthcare or pharmaceuticals has been something that we've generally been a bit circumspect on, but after a reasonably 5-year kind of a correction, we think that there is a reasonable margin of safety, and so that is the other area that we have incrementally deployed some capital towards. And lastly, among the bigger 2 sectors, both banking as well as in technology, I think we've increased some exposure over there as well.
Hi Harish, good afternoon. Harish, tell us more about this contra trade. You know, there are a lot of people who come on the channel, they talk about banks, IT, but pharma has been the ignored one, and that's been the big underperformer. And as you're mentioning, you're allocating more money to the healthcare space, the pharma space as well. So what are you looking at out there? If we could, drill it down further, is the worst of US pricing behind? And are things looking up as supply constraints now get sorted out?
So, Nigel, unfortunately, I don't have any near-term catalyst to sound out saying that this is the catalyst that we're looking out for, wherein this significant underperformance will correct itself. But the way we look at things is we look at the profit pool share of pharma. And, when we plotted over the last 22 odd years from 2000 till now, the pharma profit pool share of the top 1,000 companies is actually at its lowest that we've seen over the last 15 odd years. And that, to our mind, obviously reflects a lot of the points that you said. The fact that there was significant competition, a lot of new players came through. You've had delays with the FDA and their approvals and some site inspections not going your way. So all of that has taken a toll in terms of the overall earnings potential. And our sense is that, typically when we are at a zone which is at a multi-decadal low of profit share, that typically is a reasonable good time to assess the overall sector. And therefore, which is where we are incrementally allocating there, where we think that currently there is maybe too much of fatigue. People have kind of given up on the sector, which was not the case about 5 years ago, where everybody was touting on India's as the destination for pharmaceutical en masse. From a catalyst point of view, while we don't have any near term, but I do think that the current dynamics, especially for US, means that a lot of tail companies, companies which have got very few approvals, will slowly vacate out. And therefore, we'll start seeing some pricing power come back into the hands of the bigger franchises. So in some sense, that's the narrative that we are expecting to happen. Whether it's going to play through in the next 6 months, 12 months, we are not so sure. But we do think that there is a reasonable margin of safety, and which is where we are kind of increasing our exposure there.
Okay, so that's a view coming in on pharma. Interesting thoughts there. Harish, good afternoon. Surabhi here. Just a while back, I was actually chatting with Nilesh. We were doing a conversation for our digital platforms, talking about just how to, place yourself in a market as volatile as this. And guess what? I asked Nilesh, listen, please give us at least one money-making idea for this year. So very rare for Nilesh to say anything, right? But he said infrastructure. If you really push me to it, I'd say infrastructure and manufacturing is what you have to look at this year. So now let me ask you, how are you positioning for this in the portfolios? There are a lot of, companies are really getting orders. We see it on a daily basis, but it's a very large amorphous space. So if you could just, specify a little further and how you are playing it.
So I think clearly private capex, after almost a 10-year kind of phase wherein private capex was flat at around 6.5 lakh crores on the listed space, we've started moving it beyond 7 lakh crores in the September and December quarter on a run rate basis. And we do think that this number can potentially be closer to 9-10 lakh crores over the course of this cycle, over the course of the next 2-3 years. This is on a yearly basis, of course. So that sets the base for some very interesting opportunities that do come through. We're reasonably more sanguine on the prospects of companies which cater to the process industry. So companies like, for example, bearings companies, explosives companies, or it could be in the form of automation companies. A lot of them are multinational corporates, which have invested during the long downturn that was prevalent in India. And now, at least in few of them, we are actually starting to see India coming out as an export hub for many of their products, given what's happening in Europe and also what companies are trying to wean away from China. So I think this is not just a hope trade. We are actually seeing it in the work. So that's an area that we are positive on. The other areas which haven't actually quite performed are areas like cement. Which again we think can be in for an interesting time as energy prices kind of cool off. That's the space that we think can benefit with increasing consolidation and better pricing power prospects. Similarly, gas utilities, another area which got hit very badly because of what happened in Ukraine and Europe, I think is seeing some softening, and there have been some regulatory reforms and nudges that have come through. That's again an area that can see some kind of interesting traction. And lastly, I would say autos and auto anchs. Again, a very interesting manufacturing space where we do think that the next 2-3 year prospects continue to remain very bright.
Okay, I heard you speak a lot about different parts of manufacturing, but the very obvious names like, for instance, road companies, that seems to be missing in your list. Is that a call on valuations? Any other concerns? Okay, I think we've just lost that feed. But that was Harish Krishnan telling us about some of the sectors that he likes. A contrarian call coming in on pharma, healthcare, and of course, they are playing infrastructure through a multitude of different ideas. Before we let you go, Harish, what I was trying to ask was that you mentioned bearing companies, you mentioned cement, a couple of other plays, even auto, but I didn't hear you talk about the very obvious infra names, like let's say tolling companies, road contractors, EPC. Any thoughts here? Okay, I think we're having a bit of a tough time with that line, so we'll keep that that question and the rest of that conversation for later. Do have to